Sense is run by a bunch of investment bankers, and their modus can help make
Hi, I'm Christine Benz. I'm here at the Vanguard Diehards Conference in San Diego, and I'm happy to be sitting here with Jack Bogle, who is really the epicenter of this conference. Jack, thanks for being here. Let's talk about the current market environment. It's crazy. Give us your take on what's going on, and what do you think investors should be doing?
Well, of course, I've only been in this business for 57 years, and I have never seen anything like it in my life. I've never seen anything like the amount of speculation that's going on in the market, which is basically twice as much stock trading, twice as much turnover as we had in 1929, the previous high. We have these frequent days. We've had 37 of them in the last year where the market's gone up or down 2% or more. And when I came into this business in 1951, we might have had 3 or 4 days a year like that. 12 times as many wild and woolly days as history would have said. So we've taken the whole focus of market participation in our capitalistic system here in the U.S. From one of investment to one of speculation. And I happen to think that's a tragedy in which the investors are the losers, and which, of course, somebody's a winner. Wall Street wins. They make $650 billion a year in fees and commissions and all that kind of thing, which means that investors lose that much to the market. So it's a system that's crying out for change, although I never would have guessed the change would be so abrupt. I never would have guessed the speculation would have been so rampant. I never would have guessed that credit would be so easy. I never would have guessed that credit standards would be so devastatingly low.
So what do you think are the solutions?
Well, unfortunately, the one solution that we're going to get is government intervention. And I don't think there are very many people that really like or look forward to government intervention. I don't know anybody that thinks the government can do a better job than the private enterprise side of the system. Although in the case of the financial system, they certainly can't do a worse job. But the government is the only vehicle, the only body, the only source of liquidity we have left. So the government has no choice but to intervene. This is, in fact, the greatest financial crisis since the Great Depression.
So one thing I've been thinking about, if you are not a speculative investor, if you're a long-term investor, and yet there are these speculative investors buffeting your returns about, what should your reaction be? Should you be doing anything differently?
I think basically you should not be doing anything differently. I mean, investment is a pretty simple thing. Investment is owning businesses, or I would say, being an inveterate index fund person, owning all of American business, owning every company in America, letting capitalism do its work. Those companies will grow at probably around 7% a year. They'll pay you about a 2.5%, somewhat lower than history, but a 2.5% dividend yield. And that should, over time, bail you out of anything that happens because of the wild swings. I mean, if you visualize investment as growing in kind of a steady line, which it does, and visualize the crazy market as being all these jags up and down around this steady line, upward, always upward, I think, then you've got to say, I know I'm not smart enough to get out at the high. I know I'm not smart enough to get back in at the low. So I'm just going to stay the course, as we would say at Vanguard, and hang on through all that. And importantly, if I'm trying to accumulate money for retirement, or to buy a home, or to educate my children, what you want to do is keep investing. And say, how can I keep investing the day that the market goes down 600 points? That's the greatest time in the world to invest. It's certainly better than doing it the day before it goes down 600 points. And I think people have lost sight of the fact that a sharp market decline is, of course it's bad for sellers, but it's good for buyers. And since the stock market is the interaction of sellers and buyers, it's always good for somebody.
Right. Just to switch gears a little bit, I know you have a new book coming out shortly, within the next few months, and it is called Enough.
Enough.
Tell us about the genesis of that book.
Well, first it's a sort of my critique of American society today, my critique of how we think about money, my critique of our financial system, my critique of what we've done to business, how we conduct business, and in fact, how we conduct our lives. It's called subtitle of Enough is True Measures of Money, Business, and Life. And it's a philosophical book. Of all the books I've ever written, it was the most fun to write because I have a bill of particulars out there that I back up with all the facts that I have at my command to say we need to improve our whole society, not just the financial system, but the financial system represents in a lot of ways the worst part of it. And the title comes from a little sort of a poem that I read in the New Yorker 2 or 3 years ago, and I couldn't get it out of my mind. It's a story about Kurt Vonnegut and Joe Heller, the two famous authors, when Joe Heller was still alive, and now since then, since he wrote it, Kurt Vonnegut has died. And they go to a party in Shelter Island, lifestyles of the rich and famous kind of place off Long Island. And Kurt says to Joe, "See that guy over there, our host? Billionaire host. He made more money today, Joe, than you have made on every copy of Catch-22 that has ever been sold." And as you know, Catch-22 is probably the most successful book of the post-war generation. So Joe Heller looks at Kurt and says, "That's all right, because I have something he will never have. Enough." So it's a little bit about thinking about what's really important in our lives, thinking about service to community before service to self, thinking about our families, which I'm certainly not that good at that, but I do my best, thinking about trying to build a better world, think about the greater good rather than accumulating all the money or all the prestige or all the wealth, fame, and power, the conventional definition of success that too many people are seeking.
So teaching people how to redefine success in their own lives.
Yeah.
Sounds like a great lesson.
Well, it was fun to do, a lot of fun.
Thanks, Jack. We
Great
appreciate you spending the time with us today.
Thank you, Christine. Good to be with you. They were bearish when they should have been bullish, and bullish when they should have been bearish. So the index at least steers a steady course.
We're joined this evening by a mutual fund executive whose words are so clear they never need dissection or analysis. He's John C. Bogle, founder and senior chairman of the Vanguard Group, the nation's second largest fund company, and he joins us tonight from Philadelphia. Welcome, Jack.
Thank you, Tyler.
Nice to have you here.
Always good to be with you.
Great. You know, your Index 500 portfolio, now the second largest fund in America, has $55 billion or thereabouts in it as of the end of last month. Do you worry that so many investors who have put so much money into that fund over the past few years are going to be disappointed, not when that fund doesn't perform as well, but when some other index fund that you own starts to be the one that everybody wants to be in?
I worry about it a good bit. People should take an index fund for what it is, Tyler. This is a large cap oriented fund. There will be a time when small cap and mid cap funds will do better than large cap stocks, but it's not here now. And to my delight, it wasn't here in the decline. The index fund gave a wonderful account of itself when the market went down mid-July to the end of August.
Hey, Mr. B, Bill Griffith here as well.
Hi, Bill.
What about the big picture, though? I mean, you, more than anybody probably in the mutual fund industry, have been a proponent early on of index mutual funds, and people lately have been buying into them. But what about the concept that if we see a market continue to decline, that people will be disappointed in all index funds because they find that the managers are not allowed to sell to get out of the market?
Well, the fact of the matter is that the index fund has traditionally carried about 20% less risk than the average fund. In other words, for all the vaunted ability of mutual fund managers to raise cash, they've really been doing just the opposite. They had 14% in cash at the beginning of this bull market and 4%, only 4% at the peak. They were bearish when they should have been bullish, and bullish when they should have been bearish. So the index at least steers a steady course.
Do you still expect, Mr. Bogle, that if this becomes what people call a stock pickers market, that the index funds will continue to outperform the stock pickers?
I don't think there's such a thing as a stock pickers market, Tyler. All investors are picking all stocks, and to the extent an index fund owns all stocks, it's a sort of contradiction in terms, because if the good stock pickers take all the good stocks, The other half of the market will be owned by the bad stock pickers who pick the bad stocks. It all comes out to a sum of one.
You know, we were talking last week on the program about mutual fund fees, how most people are happy to pay them when the market's going up because they're still making money. But as the market comes down, and especially as the net asset value of a mutual fund comes down, people maybe start to pay more attention to those fees, something that I know is very near and dear to your heart.
Yeah, the fees in the mutual fund industry, I'm sorry to say, are generally pretty outrageous. And you add to an average fee of 1.5%, at least another 0.5% for the fund transaction costs inside the portfolio, which isn't disclosed separately. And then mutual funds are tremendously, except for index funds really, tremendously tax inefficient. And the index fund is going to pick up another 1.5 on tax efficiency.
You think they're going to have to come down, though, because of competitive practices and because maybe fund investors will demand it?
I think sooner or later fund investors will see the light. You see more attention paid to cost in the press. You see more dissatisfaction with the mutual fund as an investment medium in the magazines, on television. And I think the industry's got to adjust to a different era. The fees are too high, and that's all there is to that.
In addition to fees being, as your word, outrageous, a lot of people think that there are just plain too many mutual funds out there, some 9,000. What's your view on that? And I note that you guys have something like 22 or more separate index portfolios just in the equity area. Why do you need that many?
Well, you need, first, I think there are far too many funds in the industry. I mean, I don't know what one does with 9,000 funds. Now, of course, I can immediately jump to our own defense, which maybe is a little bit unfair, but you need a number of index funds because investors are getting more specialized, and some investors want the 500. My preferred index fund happens to be the total stock market, which includes large, medium, and small stocks, but some investors with a blue chip portfolio want an aggressive entry into, say, small cap growth funds. Well, a small cap growth index fund is a very intelligent way to do that. So, you know, to a point, we ought to meet public demand. We shouldn't be creating, we as a company or we as an industry, mutual funds whose only reason for being is to appeal to a marketing need that is unsound. We ought to be spending more time in this business on investing and less time on marketing.